Time for another market outlook. And as I'm doing this, I have Hyperliquid up on the screen. You can see a chart at the bottom of this screen. Oil prices $88 just last night, down to below 82, because there'll be no bombs flying. Because maybe, just maybe, we'll get a very quick deal. I don't hold out a lot of hope for that. In the background, you might hear thunder. It is threatening out there, and I live in a region where as soon as there's a little thunder and lightning, hydro just shuts down. So I may lose power during this. I may not get it up in time, but I may. Let's begin with the economic calendar. Durable goods for June up 0.3%. The previous month was down, revised, there's the R and the red, revised down to 4%. However, if you take out transportation, because that can be big and lumpy, last month was up 1.8%. May was up 1.8. June was up another 0.6 above that. Not the same growth rate that we saw in May, but still, that is growth. If you take out defense, so up 0.3. versus down negative 4.3, and XAir up 0.9 on top of an increase of 1.9. These are all good numbers. Not blowaway numbers, but they're all good numbers. Oil, this is the interesting story going forward, and the dynamic is creating a setup, I think, for nat gas. Crude oil stocks down 7 million barrels. Last week we had a build, and we were expecting a drawdown. We had a build this week, expecting a drawdown of 1.3. It was 7.1. But product, look what's going on with product. Here's gasoline. You could call that unchanged, but it's not a drawdown. That's the deal. It's not a drawdown. It was a slight build. Here, distillates. A build of 1 million barrels. The expectation was for 0.2. Look at gasoline. The expectation was a drawdown. It was a build. And heating oil, another build over here, greater than last week's build, but I mean, it's not the season for it. So you have a build in products and a drawdown in crude. This is where we are so far. If you listen to a lot of energy analysts, there is sort of a general consensus that the world is not short oil. At this point, it is short refining capacity. So we have supply of oil and you have demand of oil. There is no shortage of supply. Demand for oil are refineries. No consumer buys oil. It is refineries, and you have lower refining capacity. So the demand for oil has decreased. Once you clear this problem in the Straits, all that supply comes back online, supply that's really just not needed that much, and I think going forward probably needed less and less. I doubt strongly that there are any companies in this industry out there that have, in the planning stages, a refinery. Because it's a 10-year build-out. And then you got to get a 30-year life out of that. You got to get 40 years. You got to see your way through for 40 years. I don't think there are refineries in the planning stages, and I think go out 10 years. By the time a refinery is built, I think solid state is really going to be a thing. The predictions are that by 2030 to 2032, they will hit commercial scale in the higher priced vehicles first, and then they'll find their way down as scale increases. By 2036, you could be looking at 30, 40, 50% of vehicles being sold having solid state batteries. I think I'd wanna know that a company like GM, at least inside, is having some discussion about what that looks like for them 6, 7, 8 years out. Or are they too EV shy based on what happened last time? What happened last time was everyone decided that they needed to get into EV right away, right now, within 2 years, and have 50% of their fleet within 4 years EV. CEO of Toyota was the only one who said, wait a minute here, this really can't be done. My analysis at the time was that if everybody tried to do what they said they were going to do, there was not enough material in the world to get it done. It could not happen. And that all of these mandates will either be repealed or pushed back, and here we are. That battery chemistry, lithium, it was not the chemistry. That was going to be a bridge to somewhere, but nobody knew where. Solid state, from all the characteristics I can see, does appear to be the thing. So who's going to build a refinery now to come online in 2036 when it is a plausible scenario that 30, 40, 50% of the vehicles selling on lots will be solid state? So I think that you're going to have tight refinery capacity for a while. Look for supply to size downwards to where the refineries are. This sets up a problem. What we have going on right now, when you look at GE Verona, when you look at Bloom Energy, is they are selling natural gas turbines for the data centers to solve the power problem. We'll connect you to the grid, but you got to bring your own power. So these guys are doing very well. Well, you're going to need a supply of nat gas. In the U.S., with the shale revolution, what you ended up getting was a lot of what is referred to as associated gas. That is gas that comes out of the ground while you're drilling for oil. That's why it's called associated. And there was an explosion in production of crude oil and an explosion in the byproduct, which is natural gas. It comes out of the ground anyways. And it got so cheap that companies were just burning it off at the wellhead. Just light it on fire and burn it off. Called flaring. Well, if you cut back on the supply of oil, you cut back on the supply of nat gas. Just as the demand for nat gas from data centers that will come online in late 2027, 2028, 2029, 2030 are going to be increasing significantly, and the U.S. does want to export more LNG. So that is going to increase demand as well, because now you can sell your nat gas to Europe. It doesn't have to be just a regional market. LNG makes it a global market. So you have supply that is going to drop while demand is going to increase from data centers and LNG. The shortage of refineries is setting up a bull market in natural gas within a couple of years. At least it appears that way. Unless something dramatically changes, unless all of this goes away, it's like, you know what? Ed Zitron was right. No one's building data centers, which when we get to Microsoft, we'll see is a complete lie. We're going to look at Microsoft's earnings and what Microsoft has claimed to have done in this last year negates almost everything Ed Zitron says. So I think that's off. And LNG, well, that is a thing, and that's only growing. As far as being in the energy industry, you have midstream, downstream, and upstream. Upstream is exploration and production. Midstream are pipelines, and downstream are refineries. I would seem to think that you'd want to migrate downstream, pipelines and refineries, and underweight exploration and production, unless the E&P company is showing a significant shift in its capex towards more nat gas E&P and less oil E&P. Wouldn't it be ironic if at some point in the future, as opposed to looking at a shale oil well and saying we have associated gas, you look at a shale oil well and you say we have associated oil? We're here for the nat gas now, but that pesky oil comes out of the ground. Let's just, we'll use that to pump back into the ground to raise the pressure to get the nat gas out. Anyways, here's Hyperliquid at the bottom. 86. It closed Friday. This was really interesting. Just at the close, you had this big move up right at the close. Brought it to 86.80, and it traded as high as $88, and then boom, down it came. 81. When I took the screenshot, it was 81.63. I'm looking at it now. It's 81.81. little bit higher, but doesn't look like it's got desire to go any higher. While I'm here, while I'm on Hyperliquid, I follow S&P as well. Looks like it wants to open up 38 points. Micron looks like it wants to open up $22. Silver looking like it wants to open up around 58.60, up 77 cents. Gold up $15. Triple Q up 0.63%. That's nice. And then copper still on a run over 650. Looked like it wants to open up higher. Copper would not be at these levels if this data center build out was not true. If nothing is being built, if nothing is being done, as Zitron says, copper would not be at these levels. Okay, we have a lot here. This happened Thursday morning after the Fed meeting, in which we had no change. I'll talk about the Fed meeting coming up. I didn't make any notes on it or anything. I'll just give you my opinion. But I'm going to side with Warsh on this one as much as I feel that he lied to get the job, and he was not the guy he claimed to be in his first press conference. He was more that guy in this press conference. So I'm going to defend him a little bit because he said some things that he got pushback on that I thought, yeah, but hang on a second. He's right. You may not like it, but he's right. Anyways, let's look at GDP. When that number came out, 1.5. I thought, whoa, that is low. But you do have to look underneath the hood to see what's going on. Let's look at C plus I plus G plus X minus M. I know some of you are getting chills thinking back to your Macroeconomics 101 course going, no, please not that again. But here we are. C, 2.12 of the 1.5, 2.12. That is a strong consumer. And if you look back over the quarters, that is a very strong quarter for the consumer. And it's not one-sided. Goods, 1.08. Services, 1.04. And even in goods, durables, 0.49. Non-durables, 0.6. That is balanced and widespread, meaning a good breadth across the economy. Can't fault the consumer here. You know, I'm not diving into, well, how much of that are they paying cash? How much of that are they paying for credit? How much of that is buy now, pay later? I'm not looking into that. It doesn't really matter how it comes about. It came about, 212. Investment, 0.53. Look at that, change in inventories, 0.67. Accounting entries, but that took away 0.67 of growth just for a change in inventories, meaning that you have a drawdown of inventories, and the buildup of inventories was last quarter's GDP. So you have a drawdown. Fixed investment, 1.2. There's your data centers there. Non-residential, there it is right there, 1.15. How can you say nothing is going on, it's all been a big lie, when the numbers are clearly saying something different? Residential, 0.05. This residential construction has been in the drawdown. What would we call it? A recession, housing recession now for 2.5 years. We're going to come back to this when we get to imports, but there's 1.15. Government, that's what we want to see. Less spending from government. Federal down 0.26, state and local up 0.12, and within the federal, defense up 0.09, non-defense down 0.34. And here's what took away your growth big time is the trade deficit. Because if you're bringing something into the country and selling it, it's going to show up in either C or I, but it wasn't made domestically, gross domestic product, which means M is going to take it away. You got to subtract it out here. If you added it over here, negative 1.01. Exports added 0.5. Goods 0.63, services down 0.13, but your imports took away 1.5% of growth. Where's it all coming from? Goods over here. And if you look at what is coming in over here and what is being bought over here, it's the same thing. That the build out for the data centers is relying on a lot of imported product which is taking away the growth over here. So we're adding over here, we're taking away over here. But it still is creating employment. It's still creating local demand for services. So it's still adding to the activity within the U.S. This is the big deal for the U.S. right now, is the consumer, right? We seem to say, well, so much of growth has been funded by the government and by the data center build out. This whole economy is built on that. And it is true. If you go back to 2020 and you say, what if the U.S. ran a balanced budget every year? Growth would be pretty much at zero and slightly below zero. You have a no growth economy if you didn't have government spending. Well, now you have all of this investment going into AI. That's sort of taking over. If you didn't have that and you had a balanced budget, yeah, the American economy would suck. But who cares where growth comes from? This is growth just as much as anything else. But the consumer, that's the big deal. The consumer, 2.12. Can't argue with that number. It's a good number. Some other things here. Personal income. This is from the PCE report. Now, PCE, we'll start there. This is the core. 0.1. The expectation was for 0.2. Last month was 0.3, but based on CPI and PPI, we knew this would come in light. So I don't think any of this was much of a surprise. 0.1. Personal incomes and personal spending. This is surprising. This is for June. 0.2 on personal income, coming off of 0.7, still growing. Right? It's a low growth rate, but still growing. And personal spending coming off of 0.9, you had 0.3. This one here troubles me. The GDP price index, quarter over quarter, 6.3, expectation 3.6. How can you be off by so much that I think, was that a data entry issue? Did somebody mean to put in 3.6 and they just hit 6.3? Here is our headline price index for PCE, negative 0.1. That was for the month of June. We know that oil prices came down in June. They went right back up in July. So when we get the July numbers, we'll expect to see that pretty much reverse. Year over year, price index 3.7, expectation 3.7, down from 4.1. Core PCE prices year over year 3.3, expectation 3.3, down from 3.4. This is still very far away from that 2%, and that is the big criticism thrown at this press conference and the Fed decision. Is you said 6 weeks ago that anything on the other side of the decimal point, 2 point whatever, is what you were focused on. Well, we're at 3.3 on the core, and you chose to do nothing. I can see, looking through the oil price spike and all of that, the longer it goes on, the less you can look through it. But you said, and here it is, still at 3.3%, and you did nothing. So the concern now on the long end of the curve is, maybe Warsh is just going to talk tough, but he's really not going to raise rates because his boss ain't going to like that. And you got an election coming up. Uh-oh. We'll look at the probabilities for September. Here is PCE prices quarter over quarter. Because we have the advanced look at GDP, 5.1, but we know that energy was elevated in the second quarter versus the first quarter. Real personal spending, 0.4, same as last month, 0.4, and that shows up over here as well. So I would say that PCE came in pretty much as expected, but expect that the PPI, CPI, and PCE to be stronger on a month-over-month basis next month. And GDP looked weak at 1.5, but once you look under the hood, the consumer, very strong. Okay, rates and yields. Got a lot to talk about here. It's starting to get more exciting again. Every time I try to kill this section saying it's no longer interesting, it suddenly gets interesting. The 30-year beats the cycle high from the time they started raising rates. The cycle high on the 30-year is 5.19. Took it out this week. We were at 5.16 last week. Blew right through that. 11 basis points, 5.27. 5.28 on the 20-year. The cycle high was 5.3. And we're 4.75 on the 10-year. The cycle high was 4.98. So we're 23 basis points below the 4.98, and the 30-year is already hitting new highs. You got to go back to early 2000s to get a 30-year at this level. There was no rate increase this week, so money market funds priced that out over the next little while, saying, okay, well, we're not going to get this one, and pull back a bit. But since the beginning of the year, all elevated. The money market rates have their primary effect in derivatives and repo pricing. So companies with floating rate, short-term floating rate debt that finance their liabilities with short-term floating rate debt, that affects their costs. And this is consumer credit, the longer end of the curve. The 2-year sitting at 4.28. Effective federal funds rate's 3.63. There is a empirical observation that the 2-year rate leads the Fed funds rate by about 2 quarters. So a naive interpretation would be, well, the Fed funds rate is going to increase towards the 4.28. That is 60, we're at 3.63, 65 basis points higher. So 2 rate hikes, and by Q1, ZQ's pricing in 48 of those 65. Or it could be that the market looks at this Fed and says, you know what, we're not going to get the rate hikes. Inflation expectations get built into the long end of the curve, the 10, the 20, the 30. But money market policy, the Fed funds rate, find its way into the 2-year. There's less of inflation premium or term premium in the 2-year. So it reflects a lot of the money market rates. That the market will trade this down towards the 4% level, maybe under 4%. If there's a feeling that you're not going to get any rate hikes at all, then the 2-year is going to have to approach the effective federal funds rate, thereby giving the illusion that, well, look at this, the 2-year was 2 quarters ahead of the Fed funds rate. The Fed funds rate doesn't have to move, the 2-year just has to come back down. So this idea that the Fed follows the 2-year, only, you see an empirical regularity on it, only after all the expectations of what the Fed is going to do gets built into the 2-year. It's not as if the 2-year is unhinged from the Fed and does its own thing, and the Fed looks at the 2-year saying, oh, well, the 2-year's here, we better raise rates, we better lower rates. The 2-year is a reflection of what the market thinks money market rates are going to be over that period of time, mostly from direction from the Fed. This Fed doesn't want to give any. So the market is like, well, what are we going to do with the 2-year? If you're not going to tell us what to do, what do we do with it? So that'll be interesting. But the long end of the curve just keeps going higher. I don't think this is monetary policy on its own. A lot of it is fiscal policy, and we're going to talk a little bit about that. Japan is a very good lesson, and we're going to see that the U.S. is already on the same path as Japan. So yeah, over here, for the 10-year, the 20-year, the 30-year, I gave the cycle highs. We're already 6 basis points above the cycle high on the 30-year, 2 basis points away on the 20, 23 basis points away on the 10. TLT down another 1.2%. And I think on TLT we have an 82 handle at this point. Let me just verify that. 82.25. And a couple weeks ago, I said I think it's inevitable that we see a 7 handle on this, 79.99, and then lower. We're 82.25. We're hitting 52-week lows, multi-year lows on TLT. Given what's going on at the fiscal level and at the long end of the curve, and with the market saying, well, the Fed's not telling us what to do anymore. What do we do? Let's just assume it's bad news. I think it is inevitable, and I have said this quite a few times over the last little while. There's nothing that would make me touch the long end of the U.S. yield curve at this point. I don't think that I would touch it until after the midterm elections and we see how that works out. I don't have a good feeling and a good anticipation that it's going to end well. And I think there will be a crisis in markets, and I think that crisis will show up first in the U.S. dollar and the long end of the yield curve. So I hold by that prediction that you're going to see a 7 handle on this, and that this is not over. You know, from day to day, it could go up, it could go down, it could go up, it could go down. Being that if we open, if we open tonight and tomorrow with oil down $5, you might get some relief in the long end of the curve for a while, but the fiscal story will take a hold, and I think it gets worse. Warsh, Wall Street Journal had a story that Warsh is considering, or at least he floated the idea of fewer meetings. It wasn't a formal proposal, it was just a point of discussion thrown out saying, hey guys, what do you think about going to 6 meetings a year instead of 8? Now, he has a history of this, as per the Wall Street Journal. He did recommend this to the Bank of England, saying to them, you guys are meeting 12 times a year. Things just don't change fast enough that you need to meet 12 times a year. Dial that shit back. And they did. And he's saying the same for the Fed here, is like 8 times a year? Things don't change fast enough for us to meet 8 times a year. Now, he has to meet at least 4 times. That is part of their mandate from Congress. They have to meet at least 4 times a year. They meet 8 times, and that's been going on since 1981. He's saying, why don't we bring that down to 6? Now, that's just a discussion. It wasn't a formal proposal. One of the working committees is on communications, reporting at the end of the year. Maybe we'll hear something about reducing the number of meetings. Can you imagine moving away from quarterly reporting to semi-annual reporting and only 6 meetings a year from the Fed? The market will have to figure out a lot of stuff on its own. Right now, we've been outsourcing a lot of our own thinking to the Fed and to 4 quarterly reports. What if we have to do it on our own? Dear God. Fed funds futures. Effective federal funds rate 3.63, Q3 17 points, Q4 21. Sort of suggesting, somewhere between 1 and 2 hikes by the end of the year. Q1 for 10 gets you to 48.5 by April. And I had 22 contracts on the result of the meeting. We got up to 95, 90. I cashed out. I'm day trading this stuff. Well, I shouldn't say day trading. I'm short-term trading this stuff now. And we did have a pullback. So for the July contract, I started adding only 2. I'm just going to buy 2 at a time. Probably every basis point I'll add 2. Nowhere near the 600 I had, but I will opportunistically short-term trade this thing. Let's look at U.S. debt, because we are going to hit a milestone in the month of August. You're sitting right now at $39.911 trillion of debt. You have less than 1 month to hit 40 trillion because there is no debt reduction. So even if you have no more spending that requires issuance of debt to meet increases in spending, just the interest rate alone will get you to 40 trillion before the end of August. $40 trillion. With Trump and Elizabeth Warren calling for the removal of the debt cap. Just get rid of it. Just get rid of it. Why have a debt cap where we have to keep talking about the level? Just get rid of it so we can run up that credit card. The interest per day in the U.S. is $3.7 billion. That is $4,000 a year per citizen. So if you're a family with 2 children, 4 people in the household, your household is responsible for $16,000 of interest a year. It's got to come from you. It's got to come from you somewhere. All of this spending has to come from you. The U.S. doesn't get to tax a Canadian citizen, an Australian citizen. We don't have to submit to the IRS. So all it can do is tax its own citizens. It's got to come from you somewhere. And if you can't get it from your income, they'll get it from your capital. You get a more left-leaning government, they are coming for your inheritance. They are coming for your parents' house. You're not going to get to keep that. At $16,000 a year for a family of 4, that is your share of just the interest on the debt. And it's set to get worse. This debt level, by the way, this 40 trillion coming up, it has doubled only since 2016. So on this trajectory, by the time you get to 2036, it could be $60 trillion. The U.S. will be the world's second largest economy behind China, and shrinking the way Japan does. And I'm going to show you how Japan is shrinking. But the policies the U.S. is enacting right now almost puts it on a guaranteed same path as Japan. To put this debt in perspective, it's $119,000 per citizen. So if every citizen came up with $119,000, you're good. So go back to this family of 4. That's $480,000. Your share is $480,000, and it's $16,000 a year on the interest for the family of 4. Well, that's a house. So that house you're living in, just give it to the government, and you could pay off your share of the debt. Now, to be fair, the U.S. would never, ever, ever get to zero debt, and it would be stupid if they ever did, because you need, if you're going to have international trade, you have to give other central banks a reason to hold U.S. dollars to do business with you, which means you got to give them a yield. So you're going to have some level of debt to make international trade possible. Maybe somewhere around 60% GDP instead of the 125 now. So cut it in half. So it's really not 119,000 per citizen. Really, it's not 480. It's more like 240,000 would be the amount that really should be paid off. So half a house. The World War II peak, by the way, was 119% of GDP. Right now, it's 125%. No war. Well, I shouldn't say no war. You've had 3 forever wars. You've had to finance Iraq. You have to finance Afghanistan. And now you're going to have to finance Iran with more military spending to buy equipment to fight a war from 1980. Because that's what happens when you have 80-year-olds running the show is, well, remember the good old days when we were great again. Let's make these big battleships. There's your debt. There's your GDP. Nominal, because debt is nominal, so you're 125%. Okay, the effect on real yields. They're all higher. That is negative for gold. You can see gold and silver having a hard time. Gold is having a hard time at 4,100. Silver having a hard time at 60. Now looking like it's having a hard time at 59. Copper having no problem, and same with aluminum. Your industrials are having no problem at all. And this week, the auto catalysts really came along, platinum and palladium. Look at the real yield on the, our 30-year real yield reached 3%, 3.03 on a 30-year. I think that goes higher. Your 10-year real yield, 2.47. This is the real threat to valuations and to investment is higher and higher real yields. And not much move in the inflation expectations in your break-evens, but they are higher, but by basis points, single-digit basis points. When you look at the 5-year real yield, up 72 basis points since the beginning of the year, that's incredible. Now, one of the criticisms thrown at Warsh was his comment about the market doing its job. But I've been saying that for how long now? Look at the long end of the curve. This is where consumer credit shows up. And the market has already raised rates 2, 3, 4 times. The market's already raised rates. That's what the market does. That's what the capital market is. When the government, I shouldn't say the government, when the Fed steps in to buy bonds, they are distorting the price of risk. They are distorting the time value of money by pushing down that curve. And everything is priced off that curve. So you get a mispricing of risk in the economy. By letting the market determine where yields are on the capital market curve, the market determines the allocation of capital. I got to defend Warsh on this. He's not saying, look, I'm going to let the market do my dirty work. He's saying the market does what the market should be doing. Pricing it out, discovering where the price happens to be so that there is less chance of a misallocation of capital. I agree. I don't think they should be in the business of manipulating rates. But at the same time, he has to see that given the level of debt, given the broken nature of democracy, given the one-way trajectory of spending, this debt is going higher. The interest rates now are going higher. There is no issuance from the Treasury anywhere along the curve that can issue at a lower cost than their cost of debt right now, which is 3.4%. Every issuance is higher. Interest expense is only set to go higher, period. And the higher that 30-year goes, the higher the 20, the higher the 10, the more likely Besant is going to continue to lean on money market instead of capital market issuance. In other words, he's going to starve the long end of the curve. So at some point, the Fed is going to have to step into the capital market. At some point, they're going to have to. If the government can't control itself, the Fed will have no choice but to follow the Bank of Japan and own a significant amount of government debt. There'll be no choice. We're going to look at Japan next and see where it happens to be. But there'll be no choice. He will, as much as he doesn't want to, he will have no choice. And maybe some of his conference today was the recognition that, look, raising rates doesn't make a lot of sense because the capital market curve is already elevated and that's what consumers borrow on. And if I raise rates, what if the market thinks, well, that'll cure inflation and long yields come down? That is easing. I am now easing policy because of what's going on. To maintain tight policy, you would have to raise rates and run off your balance sheet at the same time. Well, we know he's not doing any of that till the end of the year, till he gets these working committees done. So I don't think that he can. I don't think a rate hike would have done anything. And one more point to defend Warsh on this one is, what do you think it would have solved? It's not going to fix the price of gasoline. It's not going to fix the price of diesel. It's not going to slow down the data center build-out. 25 basis points is not going to make a difference to these guys at all. They are raising their CapEx, saying, look, memory prices are higher, so we're going to raise our CapEx another $5 billion. They're taking it. They're not saying, oh, we should slow down. It's like, no, we're just going to spend more. It's not going to slow them down. It's not going to change the cost of healthcare. It's not going to change the cost of tuition. It's not going to change the price of food. Really, when we look at the categories of where prices are showing up, what are they going to do? Usually when you raise rates, it's really the big durable sensitives that you hit first, which is housing. And almost every recession, almost every housing recession ends up being an economic recession, except for this time. Housing's already in a recession. What are you going to do? The interest rate, because our economy has become so financialized, and there are so many hedging tools available, the interest rate is almost useless. So I don't think that a hike in interest rates would have done anything other than raise the cost of repo financing for balance sheet companies. But I don't know that it would have done anything for the capital market, and it might have made things worse by lowering capital market rates, which lowers consumer borrowing rates, which increases demand. So rock in a hard place. He's certainly at. You got to be seen as doing something, but doing something would just make things worse. look at the September odds here. This is where we are right now. Only 18%, 35% probability that nothing will happen. Up from 18%, and 65% probability that you'll get a rate hike, up from 55. Now, these numbers don't add up because there was a possibility of 2 rate hikes, one in July, one in September. Well, July is gone, so the probabilities have shifted inwards a little bit. Some of the ones shifted to here, all the 2 rate hikes had to shift to 1, but this was 1/3 chance of a rate hike, two-thirds chance of nothing. September is now 2/3 chance of a rate hike, 1/3 of nothing. And this is a year end. We are here right now, 350 to 375, and it is all higher. There is no probability on a rate cut this year, none at all. And 1 or 2 hikes, you're talking over 70%. The weight is on 1 or 2 hikes. That's shown in ZQ. CL was down 5.58% over the week. It looked like it was going to open higher on Monday, but given where hyperliquid is now, we are going to open a little bit lower. Well, hyperliquid now is at 82.05, still down $4.80, still down quite a bit. Nat gas down 4.17, down 25% year to date. All of these orders and all of this backlog from GE, Verona, and Bloom Energy, some of these deliveries aren't going to happen until like 2030, and probably not coming online till late 27, 28. Once you get into 2028, 2029, and again, given that the bottleneck is the refinery, you're going to have a reduction in oil production, which means you're going to have a reduction in natural gas production right when the demand is going to start to peak. I think it might be worthwhile to start looking at companies in the nat gas space now, checking out their quarterly reports, listening to their conference call. Are they saying anything about what they're seeing for the future? Wheat, oh my God, it just keeps dropping, down 6% in a week. Last price I saw was in the $6.30 range. The week before we were as high as, we printed over $7, $7.05. Corn down 5%, soy down 6%, hogs down 4%, cattle up. And mortgage-backed securities, well, the higher the 10-year yield goes, the wider the spread between the 10-year and the mortgage rate. Not good for mortgage-backed securities. Agency and Annaly had a good enough week, not raising rates, so it's not raising the financing cost that they face. But year-to-date, not too impressive. However, we have 6 months behind us, so if you take half the yield, 6.16, add the 1.61 on price so far, you're 7.77%. 777. 3 sevens in a row. What happens when you get that on a slot machine? You win a couple $1 million, right? Look at that, 777. There's the winner. As opposed to all the 666s I've been seeing everywhere. Nice to see a 777. And for our Chinese friends out there, I'm sure there's an 888 somewhere we can find. Corporate spreads, not much, but year to date, look at this, triple C. We were at 8.85, the spread on triple C, peaking over 10. I haven't seen over 10 in a while on triple C, peaking over 10. And do I hear a canary chirping in this coal mine? Is that it? Or is that just wishful thinking that I hear a canary? Actually, I shouldn't say wishful thinking. Is it just a bias that it sounds like a canary in this coal mine? But 10, over 1,000 basis points on the spread for triple C, 121 for the year. The mortgage rate, 6.66%. I tell you, I don't know why. Maybe, somebody pointed out, maybe you just have a heightened awareness of the number now that you see it once. You just tend to see it everywhere. Maybe that's true, but I don't remember seeing 666 as many times as I've seen 666 just this year alone. 666 on the 30-year fixed rate mortgage. We did have some housing data this week. Home price index for May up 0.3%, up 2.2% year over year. Case-Shiller up 0.9, up 1.6% year over year. Mortgage apps for July 24th down 6.4%. You're getting over 6.5%. It starts to be a bit of a deterrence. I think the cycle high on mortgages was just a little over 7%. So we got a ways to go on that one. What pushes it over 7% is a 10-year getting higher and the spread getting wider. That is going to hurt this whole complex over here. Repo 0. Reverse repo. Well, it's the end of the month. You expect it to build. This will reverse out next week. 2.1 billion. Reserves under 3 trillion, but only because the TGA had increased by almost 200 billion. SOFR sitting at 3.65. The Treasury holdings 6.345 trillion, down 10 billion, but that is just the runoff in between coupon dates and maturity dates, which is the 15th of the month and the end of the month. So going into next month, that will just reverse out. Warsh has said we're not doing anything to the balance sheet until the market fully understands what we're doing, and then we'll implement it. I don't expect any real change in the balance sheet till you get to the beginning of next year, and that's even if we get any meetings. Maybe he might just cancel the whole thing and wrap up shop. But he has committed to press conferences to the end of the year. That's it. He said there's a schedule of press conferences. We'll commit to those press conferences for the end of the year, but it wouldn't be surprising if going into 2027 you see 6 meetings a year and no press conferences. My God, the market will have to do that thing it hasn't done for a while. Critical thinking. How will they survive? Okay, let's have a look at Japan. Intervention. Thursday night at 9 o'clock. Again, they have a penchant for Thursday night at 9. I seem to think if the yen ever gets back to this level, well, it will when it gets back to this level, I think a good strategy would be every Thursday night at 8:55, go long the yen, and then close it at 9:05 if they don't intervene, because they just have this penchant for choosing Thursday night at 9 o'clock. I don't know why they do it, but there it is. Thursday night at 9, they spent $59 billion to get that done. And it wasn't just Japan that intervened. This was coordinated. Japan, U.S., and South Korea. I don't know that the U.S. did anything other than put the rumor out. They conducted rate checks and told banks to, and this is their quote, stand ready for future action. South Korea bought the won against the U.S. dollar on Friday, driving the U.S. dollar up, which will give driving the U.S. dollar down because they're selling the dollar to buy the won, which will also benefit Japan as well. That was bold, right at closing. That's intentional, right at closing. So this is Japan, and then the market just said, ha ha ha, you think that's going to work? Backed over 160 in no time. So they tried again, and you think that's going to work? So let's wait till the end of the day. Look at that. Let's do it again, and let's wait till the end. Right at the very end of the day, into the last second. There. Now you can't do anything till 6 o'clock on actually 5:15 today. It is 10 after 8 in the a.m. as I do this. 5:15, 9 hours, 5 minutes. We'll see what happens to the yen. Debt to GDP, 252%. You get some discrepancy here. The Japanese government reports it at 187.6, but they're only counting central and local debt, which is a managed number, that 187. Managed in the sense that it's like adjusted earnings. It's well, don't pay attention to this and don't pay attention to that, and let's adjust this, and we'll add this in, take this out. Oh, look at our earnings. Look at our gross margins. We've adjusted for, we took out depreciation, of course. Look at our gross margins. Look at our debt, 187. As a percentage of GDP. That's still quite high. It's 252.4. You have to look at general government debt. That is at the national level, the prefectures, Social Security, and government-controlled entities. You get to 252.4, but a very low overall interest rate. The interest expense per citizen is low. In US dollars would be comparable to like $100 a year versus $4,000 per citizen in the US. Their interest rate, their average interest rate on their debt is very, very low. But they can't raise it. Look at the size of that debt to their GDP. Let's add another wrinkle to that. Look at their population in 2010, 128 million people were consuming in Japan, buying food, paying for their cell phone, paying rent, living somewhere, eating food, buying clothes, all that kind of stuff. By 2026, it's only 121 million. 7 million people gone. Same population they had in 1989 in 2026. They're losing about 0.5% of their population per year. They're down almost 4% since 2020 alone. Almost 4%. The projection is by 2070, they will have an 87 million person population. You're not going to have the same GDP at 87 million as you had at 121. It is hard to grow your GDP when your population is shrinking. And Japan has another problem other than just a shrinking population. Those that are left are an aging population as well. So you end up with lower economic growth potential because your output is a function of capital and labor, and then of course your total productivity, your factor productivity, your factors being the capital and labor. If you have lower L, you're going to have lower Y, potential growth. So lower economic growth potential, that is a shrinking tax base, fewer people paying taxes, and lower economic growth to tax. Rising healthcare costs and rising pension costs, this is not going to get any better unless you do something. You have to raise tax revenues and lower expenses, which means you got to say to your citizens, look, you're going to have to be responsible for some of your own healthcare, maybe more of it than you want to. And pensions, we got to cut them. And as far as economic growth, immigration, we have to get our population back up. We have a population problem. Well, this goes deep in Japan, culturally deep for thousands of years. Japan is for the Japanese. Even going back into the 14th, 15th, 16th century, Chinese ships knew you do not approach the island of Japan. You just steer clear because you die. Japan is for the Japanese. So they're not going to fix this with immigration. They are pretty much culturally set to continue shrinking and leaving that debt behind, which will only get worse. And now they have inflation and a low currency. And the currency is a function of interest rate differentials. They can always raise interest rates to get rid of the inflation, which would strengthen the yen, but would make their debt even worse. And the debt is too big to raise interest rates on, so that's not a viable option to raise interest rates. So you still have a shrinking population and a depreciating yen. So they step in to intervene, which never works for very long either. There is no good solution. So all you're left with are bad solutions. However, there is one variable, one state of affairs that makes it impossible to implement one of the tough solutions, and that is called democracy. And that is the problem the U.S. faces right now. Any government that attempts to cut benefits and raise taxes will not survive the election cycle, because the citizens are perfectly okay with this. And if the citizens are okay with voting for more spending, well, then the citizens have to be responsible for the debt, which means if we can't tax your income, we can tax your capital. You got a house, right? Maybe we'll double the property tax on your house, so you'll pay your property tax to your municipality, and then you'll pay the equal amount to the federal government so that we can pay down the debt, so that we can spend more. No matter how much they take from you, they'll only spend more. Democracy is broken in two ways. Number one, everyone votes, on the basis that I'm going to get stuff. I'm just going to get stuff. And number two, they vote based on their colors, based on their ideology, without thinking that this is a job interview. It is not. It's a popularity contest. Democracy is what will take down the West. Democracy. There's a really good book out there, How Democracies Die. I want you to, if you have a chance, read that one, and then think about where the U.S. is at this point in time. And given all of the case studies they have in there of how democracies die, you would say, this is exactly what's going on in the U.S. right now. This president has been moved to action by the bond market before. Will the bond market discipline this guy again? If not, Japan is a good case study for where the U.S. is going to have to go. You're going to have to get the long end of that curve way down, which means as much as Warsh doesn't want to see an increasing balance sheet, I don't know that he's going to have a choice. That central bank is going to have to buy, at some point, is going to have to buy U.S. debt. Or, and the U.S. still has this chance. It is a much more vibrant form of capitalism than Japan. We got to give it that. But it still has this chance. Immigration. You got to get immigration back up. You have to increase the size of your population and continually increase the size of your population to avoid this trap that Japan is in. Japan can fix this. Is just say, okay, listen, we got to get back up to 2010 levels. We got to get back up to 128 million. That's letting 7 million people in. I would hazard a guess that Japan will default on its debt before it allows that to happen. Okay, let's have a look at Apple and their last quarter. Here is 2025, 2026, so we're reading this way. Look at revenue, 94 billion up to 109 billion, 16.35%. And this is a year over year for the same quarter, and then the last two columns are your 9 months. So for the quarter, product up 18% growth year over year, and services up 12.1%. This is considered rather light. They took a lot of time to talk about the record number of installed devices they have out there. Well, services revenue are a function of your installed devices. So if your installed devices are increasing and increasing, but services revenue is not coming along at the same rate, you got a bit of a problem over here at a 12% growth. Gross margins. This is just an incredible company in terms of the margins. 50% gross margins going down to operating margins to 32 and net income margins to 27. Now we do have quite a bit of a drop this year over last year because you do have some increases. R&D is a notable one. Last year was 9.42% of revenue, jumping to 10.7% of revenue this year. And a tax rate that was 16.4 last year, 17.86% this year. And this 50 point compares with last year at 46.49, but 2% of tariff refunds were in here, so it is going to show up in your cost of sales, giving you the illusion of a higher gross margin. So this really would have been 48.05 without the effect of the tariff. And I don't think there was any tariff number in here. Still 48, from 46.5 to 48, not bad. Looking at their EPS, we got to do a bit of work here. 157 last year. I always look at diluted, and you should always look at diluted as well, because that is the economic reality you have to live with, is diluted, not basic. 202, so you think that is quite an increase, up 28.67%. However, did the operations of the business produce a 28% increase in EPS? I can double EPS with flat sales by simply buying back half the shares, right? So if I buy back shares, I can increase EPS even if the production of the business is unchanged. I can make EPS look better. So we went from 14 billion 948 million to 714 million. You had share buybacks. So I took the net income and used the last year's quarter's share count to show the change in EPS. If we held shares constant, we would have reported 199. So if there was no share count change, the productive capacity of Apple itself produced $1.99, holding shares constant. And they claimed the tariff relief was 11%. Controlling for that, you got 188, which is 20% growth in EPS, not 28.6. The expectation was for 189, so it was a miss on EPS once you consider those. Now the 189, the expectation more than likely includes a share count reduction number in there. Cash and cash equivalents, marketable securities, 146 billion. Lots of money for share buybacks here. Amounts to about $10 a share. If you control for cash, you got about $10 a share in there. Outlook for Q4 revenue, 9 to 11% growth. That's not quarter over quarter, that's year over year. This revenue was 16.35 year over year, guiding to a lower growth rate of 9 to 11%, midpoint of 10. But they are saying, look, currency is going to move against us by 2.5%. That is the expectation of a stronger dollar into the third quarter. You do have July done. It was a stronger dollar through July versus last year. But, things can change. If the dollar drops, we would expect Apple to report higher growth rate year over year because they are accounting for a 2.5% headwind. And supply constraints. This one I didn't understand. They said that we have significant supply constraints. However, it is not because our suppliers can't supply us with product. They can. It's simply because we have so much demand. So it's like, well, hang on a second. If you're saying that your suppliers can supply you with product, but that your supply constraint is because you have too much demand, well, which is it? If you have too much demand, then you would conclude that given the level of demand, our suppliers can't supply us with product. But you're saying it's not because we can't get the product, it's because we have too much demand. That doesn't add up. That didn't make sense to me. So I think they meant it the other way around. But anyways, talking about supply constraints, they use the word, it's their word, significant supply constraints. Significant, specifically on advanced nodes. SoC, system on a chip. They expect memory prices to increase into the September quarter, which is the next quarter they'd be reporting the end of September. Memory prices to increase for the September quarter and thereafter. Memory prices to continue to increase thereafter. Well, think about Micron, think about your suppliers. Now, when they talked about suppliers of memory, they said there are only 3. They didn't say 4. They didn't mention the Chinese company that went IPO. They just said there are 3 suppliers of memory, and that's it. They're guiding iPhone growth into the mid-teens. Gross margins 47 to 48%, 1% for tariff relief. So if you're at 47.5, you'd be more around 46.5 for the quarter. There you are, 46.5, matching last year. So the gross margin we're seeing at 50% this quarter seems to be sort of anomalous. They're guiding back to the 46.5%. Tax rate 16.5%. They're guiding back to the tax rate they had last year. OPEX 19.1 to 19.4 billion. They're at 19, almost 19.1 now, so 19.25 for the midpoint. Net income 31.67 billion. I calculated the net income by just taking their revenue times their gross margin minus the OPEX, the tax rate, you get to 31.67. EPS of 2.15, holding share count constant. You get an EPS of 2.15. For the first 9 months, they have diluted of 688, add the 215, that's 903. They are trading based on their closing price right now at almost 35 times 2026 earnings. That's not really a forward earnings multiple. It's like a 0.75 weighting on the trailing and a 0.25 weighting on the forward. but they're trading at 35 times 2026 earnings. As far as breaking down their product, I don't know if you listened to the conference. Tim Cook was talking about iPhone up 21%, blah, blah, blah. iMac up 28%, blah, blah, blah. iPad, we had sales of $6.2 billion. Wearables up 6.5%. Services up, but didn't say down. Just ignored it altogether. I'm not even going to say anything about that. I'm just going to say what the sales were. But talked about the percentages of each of the three. It's like, dude, do you think we're all stupid? Like, do you think we're so stupid that if you don't mention it, we're not going to know, we're not going to see it? It took the next person to say it is down because we have a difficult compare versus the A16 iPad last year. So that sales were down. It was such a great product last year that it's a hard comparable to beat. I don't know, take it for what it is. That's what they gave. So that was a bit of a negative on that one. And services only up 12%. That was a bit of a drag because here you are talking about record level of installed devices for iPhones. We gained share. Record level of installed devices for Macs. We gained share. And services are a function of all the installed devices you have. In part a function of all the devices you have, because if you don't have a device, you're not shopping at the App Store. And 12% seemed rather anemic on that one. So overall, good company, good margins, good product. I use their product. They are guiding to more expensive memory prices, so their product prices are going to have to go up at some point. That starts to hit the consumer. They talked about the upgrade cycle, and there were a few questions on upgrades, and I think that's an important question. With prices going up, maybe I don't have to upgrade every 2 or 3 years. Maybe I go 4 years or 5 years. That would hurt their product sales significantly. Okay, AXTI reported earnings this week. This was a spotlight company, and I have 23, or going into earnings, I had 2,300 shares, and it had fallen back. It breached 130 and fell all the way back. It was for a while under $40. It printed like, I think the low price was 38 and change. What a drop. I held all the way through because of the space that it's in. It is a bottleneck company, indium phosphate, and it was guiding to a great quarter. And man, what a great quarter it had. It was hard to find any fault in what they're doing, and disciplined CapEx. It gave me everything I wanted to see, and it knocked it out of the park. Let's have a look at what it did. Its revenue quarter over quarter up 50%. This is 2025, June 30th, 2025 versus 2026, year over year. Revenue up 164%, 17.9 to 47.5 million, up 164%. Gross profit went from 1.4 to 21, up 1,390%. Look at your gross margin, 8% gross margins, all the way up to 45% gross margin. Income from operations from a loss last year to income this year, margin 21.9%. This throws things off a bit. You have some non-operating interest income because they did issue shares. They have a bunch of cash on their balance sheet, so they ended up generating some cash return. I kind of skews the numbers, so I'm going to take that out. The after-tax portion I'm going to take out. Here is your net income attributable to AXT, 11.128 million, 23.38% margin. Your share count increased from 43 to 63. Look at your diluted, went from negative 16 to positive 17, while your share count increased by 50%. So if we take out the proceeds of the interest income, this is if they didn't do the security offering, they wouldn't have this share increase, and they wouldn't have this. So we'll use this as our diluted share count, 43.7 million. But let's take out this. We would have gotten to 20 and a half cents a share, holding the share count constant and removing this income. So even without the proceeds, even without saying they did a secondary offering, that is even better than the 17 cents reported. So the operational part of the business just killing it. As far as their IPO for Tongmei, they said it's still on, but they pushed it into next year. Indium phosphate sales, 30.7 million of the 47.5, 30.7 million came from this substrate, indium phosphate, which is the big one, primarily for data centers. Top 5 customers are about 30% of revenue. None are greater than 10%, so not a lot of customer concentration risk. Cash of $750 million, debt of 84 million. So they have a net cash position. Once they can pretty much pay off that debt now. Looking to increase their indium phosphate capacity. They had forecasted in the last quarter that they expected to double by year end. They are ahead of schedule on that. It might even triple by year end. And then they want to double it again by the end of 2027, which would make them the largest indium phosphate producer globally. They expect to exit 2027 just from indium phosphate with quarterly revenue of about 130 million per quarter exiting 2027. This quarter was 30 million. That is 4 times higher per quarter exiting. Revenue for indium phosphate by the end of this year, 3 times. So up to hopefully getting up to 90 million per quarter exiting this year. Backlog of over 100 million. Multi-year demand cycle. Just saying all the right words. Supply is limited. Demand, multi-year, supply limited. Love to hear that stuff. Guidance for Q3. Look at this. We've got revenue, 66 million booked because this stuff has got to come out of China. You need permits. That's booked with permits, which means there is some upside if they get more permits. 66 million. This was 47 million. They're guiding to almost a 50%, another 50% increase in revenue quarter over quarter. OPEX 11 million on a GAAP basis. EPS 29 to 31 cents on a GAAP basis on a 65 million share count. We're at 63 now, so they're going to increase the share count by about another 2 million. And this is going to go from 17 to a midpoint of about 30 cents. This was the big takeaway. What the CEO has said, whatever we can produce, we can sell. It is not a demand problem at all. This is a supply problem. You got to own this one. I own it. And man, what a 2-day run it had. After hours, it was up big. Next day, and then this was Wednesday night. Thursday was up. And then Friday, it continued on again. I think we ended somewhere in the $60 range on AXTI. Do I have that right? Did they report Wednesday night or was it Thursday night? I forget now. But we're somewhere like from a low of $38 to somewhere in the $60 range. How did they ever get that low? Well, it turns out we had a massive delevering going on. I'm sure you've all heard by now about situational awareness. But talk about having no situational awareness. Let me take a minute and explain sort of what the problem there was. I mean, we all know, I think, it was leverage. But it seems to me that if this guy was a genius, it doesn't take much of a genius to figure out that as the volatility of your portfolio increases, you must decrease your leverage. You cannot increase leverage and volatility at the same time because the market has a fundamental layer and it has a psychological layer, or what we call a behavioral layer. And you can find a fundamental layer and you can lever up fundamentals, which is why we allow home buyers to lever up almost 20 to 1. That's a 5% down payment. And then you can finance the rest. 5% is your equity. The rest is debt. That's 20 to 1 leverage. But every payment you make, you are de-levering. The reason we let you do that is because a 5% move on housing, that's a big move. It has low volatility. You can lever up low vol assets. You take a 10-year Treasury at 4.75%. and you give me overnight funding of 3.65%, that's where SOFR is, I'll do that all day long. Now I'll have a haircut. They'll only finance 98%, but I can buy $980 million or borrow $980 million, put in $20 million of my own, and I have $1 billion. That's 50x leverage. The reason we do that is because the 2% move is a big move on the price of a 10-year. So if you have low vol assets, you can lever up. But the higher the volatility of the assets, the lower this leverage has to go. Well, this guy was in very high vol stocks. Now you can say, but he was hedged because he was long AI infrastructure and he was short software. But these things load on one factor, AI. So anything that threatens the AI trade would threaten the long position, would be a relief rally in the short position. You're not hedged. It is a surefire sign that if you think you're hedged and your positions are either both helping or both hurting you at the same time, you are not hedged. It means you are loading on one factor and one factor only. A hedge is such that if the market is going up, my hedges might be working against me. But when the market goes down, my hedges really pay off. That's a hedge. That's a hedge, a negative correlation. All you had was the appearance of a negative correlation. But you had a missing variable, which is the factor they both loaded on, AI, which has huge volatility. And then you had huge leverage on top of huge volatility, thinking you were playing a fundamental layer and completely ignoring the behavioral layer. This is a lesson for all of you retail accounts out there. The higher the volatility of your portfolio, the lower the leverage you should be using. If you are playing at the edge of your margin on high vol stocks, you're going to blow up. If you blow up, you lose money. If you lose money, you're going to have a bad time. So if the other point of the volatility is it's okay to have high vol assets in your portfolio, and you can create a portfolio of very low volatility. So I can own a whole bunch of ski hills, and I can own a whole bunch of golf courses. And each of these things have very high volatility because ski hills make money in the winter, they lose money in the summer, they make money in the winter. Whereas golf courses lose money in the winter, they make money in the summer, they lose money in the winter. But look at this, if I own two of them, I have very smooth revenue. I have low volatility because I have highly negatively correlated assets. The higher the correlation, the higher the volatility of your portfolio. This guy was highly correlated on one factor, and he used 3.5 times leverage on that. Now, what freaking bank gave it to him? If it were me and I got sued, I'd be, Your Honor, they gave me the leverage. They gave it to me. They should have known better. They should have said, well, what are you buying? You're buying that stuff. They should have easily been able to say, hang on a second, level 1 CFA, volatility of the portfolio, given the correlations you have, there's no way we're going to give you that much leverage. But they did. Everybody was to blame because everybody outsourced their thinking to, this guy must be a genius, graduated from Columbia, age 19. The market will humble the smartest of you. Remember long-term capital management? You had Nobel Prize winners in there. They blew up. They blew up because they didn't respect that psychological layer. They levered up without respecting the psychological layer. That will humble you again and again. Now, you can be right on the fundamentals, and I'm sure this guy in time will look at the market and go, God damn it, I was right. Yes, you were, but you ignored the psychological layer. You can't ignore that. High volatility is telling you something. It's telling you that the market is very behavioral because the fundamentals don't have that kind of volatility. So if the price has that kind of volatility, there's a behavioral component that you got to respect by pulling way back on your leverage. If not, boom, you blow up. Okay, let's talk about Amazon. Market really like this. On this one here, we are going the other way. 26 is this way, so we are reading that way. You got to be careful. Sometimes you look at some companies, you do a whole bunch of work going, oh my God, everything sucked. It's like, I'm going the wrong way. This is last year. This is this year. I've done that once where I'm looking, going, I don't get it. This is awful. And then I looked up and I thought, I'm going the wrong way. Ah, God. Net product sales up 13.7%. Services up 23.7%. And AWS was 21% of services revenue. North America was up 16%. International up 15%. AWS up 37%. Operating income from North America, $9.1 billion. From international, $1.7. 16.6 of the operating income from AWS. Fastest growth in 18 quarters. Free cash flow was negative $7.6 billion on a trailing 12-month basis. So I've given you the numbers that I used to calculate it. CFO minus the CapEx, minus the proceeds from sale of previous CapEx. AWS, AI-centric, $25 billion run rate. This is what they're claiming. Their chips business, $25 billion run rate. A backlog of $496 billion. The annual revenue run rate, $169 billion from AWS. $169 billion. Let's look at cost of sales here, because we have to pull some things apart here. 47.7% versus 48.19% last year. Looks like they've improved their procurement, but tariff refunds for Q2 were $600 million. That lowers your cost of sales. And $600 million as well from energy derivatives cost reduction, which is OPEX recorded, would show up in here as well. So the difference between 48.19 and 47.7 can be accounted for tariffs, which probably not going to repeat again, and your energy derivatives. Getting down to operating income, increase of 43.24%, and your margins 13.69, up from 11.43. But again, that is flowing through from a reduction in your cost of sales. Other income and expense, look at this one, big one here, $53.4 billion. That is Anthropic. They have interest in Anthropic and OpenAI. Net income up 17%. I took Anthropic out, the after-tax effect of Anthropic. I took it out. 168 to 575. You just saw the EPS. You said, oh, wow, but Anthropic was a big part. Take it out, you're at 195. You went from 168 to 195. You did have a share count increase over that period of time, so holding the shares constant would have been higher. But there we are, 195 without Anthropic. What are they guiding to in Q3? Net sales of 197 to 202. So the midpoint here is about pretty much where you were this quarter. So they're guiding it a flat quarter over quarter. Year over year, 9 to 12% growth. Far cry from where they are this quarter. But this quarter they claim, well, look, we had Prime Days sitting in here, so there's something to that. No Prime Days, so that's a headwind of about 400 basis points quarter over quarter. So if you took the midpoint as where are we, 9 to 12, 10.5, you'd be at 14.5, and 80 basis points of headwind because of Forex. Operating income 22.5 to 26.5. That's a fairly wide range. And their operating income this quarter was 27.461. They are guiding to somewhere below that level. Again, the lack of Prime Days. CapEx $220 billion in 2026 for AI and AWS. That is up $20 billion, and they blame memory for that. They said we have a clear line of sight to financial return. And they broke out data centers and servers. Data centers, 2-year lead time to build, so they need to raise money now, and then 2 years later it comes online. 30-year life. Servers, 3-month lead time. 3-year break even. 5 to 6 year life on servers. So overall, it looked like it was a fairly good quarter for Amazon, with especially the statement about the line of sight to financial return. They also quoted this: they see a $1 trillion annual run rate in time based on their CapEx. And even with the 220, still not enough for 2026 demand. Also for 2027. There's been a lot of talk about whether or not we're in a bubble. We are in a CapEx super cycle, which can look like a bubble, and it will end badly. There will be overcapacity. But every company I listen to is saying the same thing. We simply don't have enough for the demand. Now, the big thing you got to take away, because Amazon was around in the .com era. Amazon had built the largest online bookstore on the idea that let's build the site and demand will show up, right? As long as we provide supply, demand will show up. Well, now what is happening with AWS is demand is showing up, and now they have to build the supply. It's the other way around. 1999, they were building supply in hopes of driving demand. Right now, demand is driving the build out of supply. Almost every 10 quarterly report I go through that is AI related is telling the same story. It's not a matter of if we build all of this, demand will show up. It is demand is at our doors, breaking in. We have to build this. So it's that does not sound to me like the end of any kind of maybe what's being perceived as a bubble. I hear some people talking about, oh, it's a bubble, it's bursting, it's over, it's done. I would say these are not people who are listening to these quarterly reports and the conference calls, and not just from the AI companies, not just from those that are in it, because if you go back to 1999, you got the same thing from Cisco and Intel. Oh, demand is insatiable, it'll last forever. But if you were looking at the companies that were buying this stuff, they were talking about, well, demand will be showing up. Well, this is the increase in eyeballs that we got. But the cash and the revenue wasn't showing up there. That is very different. If you listen to the conference calls from not only the CapEx spenders, but the recipient, not just the recipients of CapEx, but the CapEx spenders, they're all saying the same thing. Demand is off the chart. Okay, let's look at Microsoft. Market really liked this one. I do encourage you to listen to the conference call. It is far more detailed than I can possibly cover. And there's so much. It's a little confusing to follow because there's so many overlapping categories. They don't add up. And when they gave their guidance, they were really giving their guidance more to analysts than to investors, because you had to be able to pull apart the segments and rebuild them back up. And I wasn't going to go through that deep dive. Let's just have a look at a high level what they're saying. Product sales. Not very impressive. This one here, we're going this way on 25 to 26, and it is their year end. So we do have the full 12 months. This is the quarter. This is the full 12 months ended. 17.1 billion to 17.2, up 0.57 on product. Services up 22.7%. So total revenue is up 17.7%. Gross margin, I don't know why they're using the word margin. This is gross profit. Margin is a percent. Profit is a dollar amount. So, software people. 67.19% versus 68.6% last year. A little bit of margin compression. Operating income up 18%. The margin operating, they said this right, it's not operating margin, operating income. This should be a gross profit. 45.11%, up from 44.9%, showing you do have some cost discipline in here. Other income, Anthropic, $3.4 billion. So we're going to have to take that out for a good quarter over quarter or year over year comparison. I take out Anthropic and OpenAI down here. From 481 down to 439 just for the operations, comparing to 365. So growth in EPS of 20%. This is the full year EPS, 17.95. I'm not making any adjustments here. This is their share price, so they are trading at 25 times trailing 12-month, which is pretty good because you would naturally expect growth, that their forward guidance or their forward earnings would be higher than 17.95, so that they would be trading at something on a forward multiple less than 25. Not bad, considering even after this big jump. That's not bad. Adjusted for OpenAI, it would be 17.28 instead of 17.95. The 13.64 would have been 14.13. So on an annual basis, 26 fiscal year over 25, EPS up 22.29%. The 3 point of this 3.44, 3.2 billion was a gain from Anthropic investment, which was 35 cents a share. OpenAI's gain was 7 cents a share. That's why I took off the 42 to look at just the operations, because you hear that criticism. Oh, well, most of the earnings are from mark-to-market gains on these private companies. No, not most of the earnings. You still end up with 20% earnings growth by removing those, and in the end, these are values for the companies that invested in them, so you as a shareholder, you get to benefit from it. So if you have shares of Amazon, if you have shares of Microsoft, if you have shares of Google, you already have ownership of Anthropic, of OpenAI, and of Gemini. You already have exposure to it. Azure revenue greater than 100 billion for 2026, 365. Copilot, more than 30 million paid seats. Cloud revenue, 59.3 billion, up 27%. Remaining performance obligations, 678 billion, up 84%. Average life here, 2.3 years. 30% of that expected to be realized in the next 12 months. CapEx for the quarter, $41 billion. That was made up of $35.8 billion in cash plus finance leases. And they are matching quite well. The finance leases are for long-lived assets. We'll talk about they're extending their useful life for their long-lived assets down here. But they are using finance leases for the data center infrastructure part and using their cash for the servers as much as possible. Out of this 41 billion, 2/3 were for short-lived assets, GPUs and CPUs. The other 1/3 are for long-lived assets, and most of those long-lived assets are using finance leases. Free cash flow, $19.6 billion. Of that, $10.2 billion was returned to shareholders. Amazon, negative cash flow. Google, I think, turned to negative cash flow, and Facebook, we're going to see as negative cash flow as well. Actually, sorry. Facebook did have positive cash flow, but once we account for the return of capital to shareholders, yeah, they went negative. Of this 10.2, 6.8 billion in dividends, 3.4 billion in share repurchases. Added 31 new data centers across 5 continents this quarter. I thought no new data centers were being built. They added 31. 88 in 2026, they added 1 gigawatt of connected power. 1 gigawatt. This is why I said about Ed Zitron before that based on what he says, it is easily falsifiable. The moment you start reading some of these quarterly reports, you can easily falsify his statements. Not a single data center has been built. That's bullshit. But he is a master at PR, and he is everywhere. So as far as his core business, which is PR, yeah, you can't knock that guy. As far as a tech analyst, I hope you're not paying him any money, because he's bad. This is a great quote from the CEO. Customer demand continues to exceed capacity. Same thing we heard from Amazon. Same thing from AXTI. Customer demand continues to exceed capacity. They are showing up. We have to build it. Guidance. Started with depreciation, extending the useful life for data centers and office buildings from 15 years to 25 years. I read that and I thought, wow, okay, that makes sense. I mean, if you're building one of these structures and saying useful life is 25 years for an office building, I'd say, why not 30? You know, 25 seems pretty aggressive. 15 was really aggressive. You're really depreciating that fast. right? So to go 15.25, I don't know if I'm put out about that. They will be shifting more to operating leases from financing leases, with the thinking of why do we need to own these buildings and then encourage and then see depreciation after and lever up our balance sheet when we just use an operating lease. Operating leases not included in CapEx. Finance leases are included in CapEx, but not operating leases. They are just an operational expense. 2027 CapEx, 175 billion. They expect 50 billion in Q1. This was Q4 that we had. So Q1 is the quarter just coming up for 2027. They call it 2027 CapEx because the year end is in 2027. Revenues, 90.4 billion. I took the midpoint of their range. They're pretty much at that now, so it looks like the quarter is guiding flat. Cost of goods sold, 29.6 to 29.8. Where's our cost of revenue over here? 29.5. Kind of a little bit higher for the same revenue, but you're I was going to say you're not going to have the effect of the tariff refund. I don't see a tariff refund in here, so let's back that out. OPEX 16.8 to 16.9 for their operating expense. Now, I didn't go any further because to get to EPS, there were a whole bunch of different categories in here. This really was guidance for the analysts, not for shareholders. But the big guidance here that the market seemed to appreciate was the CapEx and the growth that they are getting from services, 22.7%. They were rewarded nicely. Now, we still have, this will be interesting because coming up by the end of the year, I think we should see either an OpenAI or an Anthropic IPO sometime in the third quarter, maybe some rumblings about it with a fourth quarter IPO. And the ability, maybe they monetize some of this investment and turn it into cash. Okay, one more, Meta. You know, when I do these for the week, there's so many that I could do. I wanted to have a closer look at Qualcomm and a few others that came out this week, but you know, there's only so many that you can do in a week. Each one of these take me about 2 to 2.5 hours because I do have to listen to the conference call, make my notes. And when you have a week where you have, like, just in the S&P over 100 companies reporting, there's no way to cover them all. So I pick and choose where the tone of the market happens to be. And Meta set a tone, was not liked at all. However, it does give us a good insight into its advertising revenue, which was great. This bodes well for AppLovin, which reports on Wednesday. AppLovin cites Meta as one of its customers in its auctions. And ad revenue was very, very strong. So AppLovin sold all the way down to under 400, got down to 380. I sold 320 puts on AppLovin. And they have earnings on Wednesday. And after looking at these numbers, I think I might lean into that a little bit more. Revenue up 28% year over year. Which way are we going? We're going this way. Trust me, always look at which direction you're going. You don't want to waste any time. Up 27%. Ad impressions were up 14% year over year. Ad prices up 12%. That is the square getting bigger, not just turning into a rectangle, but impressions, more quantity, more price. Multiply the two, take out the one, you get 27.68% increase in revenue versus the 27.69. Of the 60.8 billion, 59.36 was for ad revenue. This is an advertising company, plain and simple. CFO for the quarter, 31.8 billion, capex 30 billion, financing leases 964, free cash flow of 782 versus return of capital of 1.35 billion. That can't stay. That can't hold. You can't be running free cash flow. This is cash available to be returned to shareholders. Well, you're returning twice as much as you're generating. Something's going to have to give somewhere. Share buybacks are usually the first thing to go. This is concerning over here. Let's look at their costs. Notice that their revenue is up 28%. Cost of revenue is up 33.4%. Research and development up 67%. Marketing and sales up 15%. The only category that is showing some kind of operating leverage because you shouldn't have to increase this cost as much as revenues, right? You expect the cost to increase as revenues increase, but by less. That's the only category that's doing that. General and administrative expense up 110%. This sounds like a university. Busily hiring DEI officers. 110% increase. So their costs and expenses were up 55% this quarter over last year, with revenues only up 28%. Business 101. That's not the way to run a business. Business 101, page 1. Don't spend more. Don't increase your expenses by more than you increase your revenues. That's the wrong thing. Income from operations down 8.66%. Now R&D up 67.33%. Have a look at this. Share-based compensation came in at $7.65 billion. That is 58% increase year over year. To get the people to work for you, look at how much share-based compensation you're paying them. This is shareholder money. I've made that point many times. It is shareholder money. It's just a lie the way it's written down on the cash flow statement. 58% year over year. 89% of this 7.65 goes to R&D. And R&D went from 12.9 billion to 21.6 billion. You gotta wonder what the hell is going on in general and administrative. Are they doing the core weave thing where it's like, hey, let's just take as much as we can? I don't know. In the expenses as well, maybe general and administrative, maybe it's up, maybe because that's where they classified their allowance for legal proceedings, $2.4 billion. I think in here as well is the 1.18 billion for severance. So maybe that's what's going on. That's why general administrative is up 110. That's probably where the 2.8 billion ended up in legal proceedings. And they say more is expected from these youth-related trials. More is expected, and they named a number of states that were doing it as well. Look, this opens a floodgate. There's going to be more of these for several reasons. Number one, Facebook absolutely makes its product addictive. It's the business model. It absolutely makes the product addictive. And since it gives you more of what polarizes you, and that's how you get engagement is you polarize people, you make them angry. It tends to do that. Number one, of course they're making their product addictive. They're being accused of providing an addictive product to under 18-year-olds. They absolutely do that. Number two, they got money. They're a piñata. They're a piñata waiting to be hit, and the floodgates have opened because a couple of trials have already happened that have set precedent where there's payouts. There's going to be more. Number three, you have AGs that want to make a name for themselves. Well, let's go after the big boy. And number four, you have lawyers that need to make partner. If no one's walking through the door saying my kid was addicted, they will go out in the community and say, hey, does anybody have any kids that got addicted? I can get you money. You got the ambulance chasers because lawyers. So this is not over. That 2.4 billion is probably set to go higher, much higher. This is a big deal. Cash on hand, 90 billion. Debt on hand, long-term debt, 83. Net cash position, that is on the books. And I only counted debt, by the way. I only counted debt. I did not cover the operating lease liabilities that are sitting on the balance sheet. These are non-cancelable. Guidance for Q3, revenue 61 to 64 billion. They are guiding higher than the quarter that they're in. FX, about a 1% headwind. It's fairly consistent across the companies that are reporting, that are forecasting for the next quarter that FX will be a headwind. Expenses for all of 2026, 165 to 169. Midpoint is 167. They've incurred 75 billion so far. 2 quarters left to go. They're guiding to about 45.8 billion a quarter. This was 42 billion. So they're guiding revenue to increase, the mid part of the range is 63, to increase $3 billion, but they're guiding expenses on average to increase by the same $3 billion. Not good. Operating income for 2026, all they said, and I thought this was weak. I don't know why they don't have somebody on staff that can say, well, what are you going to say? And stop them and say, okay, whoa, here's how that's going to be perceived. But this was weak. You know, there's nothing wrong with owning something. That if something is not working out, you say it. Because now you have that trust. People listen to you and go, well, we trust you. They own the problem. Tim Cook didn't say anything about iPad being down a certain percentage. Just glared over it like we're stupid. And all they said for operating income here is, we expect operating income for 2026 to come in above what it was for 2025. That's weak. Come on. You had to know that anybody listening would have went, oh, well, that's not good news then. You know, by not mentioning bad news, you know what it is? It's bad news. But if you mention bad news, then we know at least that you're aware of the problem. This was, AppLovin did this a couple of quarters ago, where it refused to tear apart the growth rate that it had in its ads for e-commerce, telling us that, oh, it was much more useful to look at it as a whole. It's like, we're not stupid. If it was good news, you would have said it. So we know right now it's not good news, and now you won't own it. Operating income for 2026. Hey, shareholders, good news is it's going to be better than 2025. You know, that's all they said. So I guarantee you it's not good. CapEx for 2026, 130 to 145 billion. Up from 125 to 145. They raised the lower end by 5 billion. Tax rate of 15 to 17%. They're at, last year they were 10.69. This year they're at 15.5. They're guiding to about 16%. Look at the CapEx. Year to date so far is 50.9 billion. They make you work for it. They don't just tell you what next quarter will be. This will be it for the year, 130 to 145. You got to find a midpoint, which is 137.5 billion. And then take off what they've done year to date. That'll be for the next 2 months, because we've got, the next 2 quarters. We've got 2 quarters behind us. So they're forecasting or guiding to 43.3 billion per quarter. Their CapEx this quarter, based on what their cash spend and their finance leases were about 31 billion. So they're guiding to increased CapEx. Given their revenue guide and their expense guide, they are actually at this point guiding to negative cash flow. So something is going to have to give on this return of capital. You can't keep that pace up. It gets a little bit worse, people. On the balance sheet, right of use assets and operating lease liabilities. Whenever you have a lease, you have an asset and you have a liability. They sort of just cancel out. But this 26.2 billion is on the balance sheet. Operating and financing leases not yet commenced as of June 30th. If they haven't commenced, they're not on the balance sheet. So if my year end, if my quarter end is today, and I have an agreement that starts tomorrow that heavily indebts me, it's not on my balance sheet today. It has to show up tomorrow. 278.99 billion that have not commenced as of June 30th. For data centers and co-locations, they commence between 2026 to 2036. So it's not like that's going to show up right away. They commence over the next 10 years, so that's not too bad, with the terms being greater than 1 year, all the way up to 30-year terms. July, they added another 68 billion to this that can commence in 2027, 2028, terms of 18 to 20 years. There's an ugly word for you, non-cancelable. These cannot be canceled. They got to go through with it. So you're talking some $350 billion in commitments that still have to hit the balance sheet. However, This is 2026 to 2036, so it's not like it's going to hit the balance sheet next quarter. But these are non-cancelable commitments that at some point are going to have to hit that balance sheet. Due in 2026, 53.52 billion of all of this, and in 2027 another 81.65 billion of this is going to be due. So going into 2027, from where we're standing right now, being that almost 100% of their revenue is ad revenue, and they're investing heavily in this AI data center with only $3 billion forecasted growth quarter over quarter, it's a question mark. They've done this before, piling billions and billions into the metaverse, going nowhere and saying, okay, you know what, we're going to stop right here. And then their share price went up. Now they're piling billions and billions into another investment category that everyone else is in. Is this going to be another metaverse for them? Do they have the execution ability to make this happen? Because these are big freaking commitments. And you are guiding, as far as I can see, to negative cash flow all the way through 2027, as far as I can see. So the market, I think, has this right, and man, did it sell off. I think it has more downside. Okay, S&P. What a run that was. 5 companies. And we have a whole bunch of companies reporting this week, so I'll probably do the same thing next week. I'm really trying to focus on those companies that give us a nice beat on where the AI trade is. Now I listen to a lot more than just those 5. I just didn't present them. It is consistent across the board, whether you have a CapEx spender or a CapEx receiver, they're all saying the same thing. Demand is off the charts. It's hard to look anywhere and find a corporation that's not saying, let's do something about this. Let's start working on the agent thing. And we're just at the very beginning of that. Things are being done. Places are being built. Stuff is being purchased. It is not an Ed Zitron story. I know I'm harping on that this week, but all last week he was out there again riding the sell-off. The sell-off turned out to be a deleveraging event, not the end of this CapEx supercycle. This is not over. This is not over. I am now long 21 contracts of NQ for September. I am long 350 shares of Micron with 5 puts being sold on it. And I'm long a couple of the companies that are in the bottleneck, but still heavily going to short the neo clouds. So I do have short positions now in a couple of optical plays and in the neo clouds. When I look at YouTube analytics for spotlight companies versus earnings spotlight, night and day, the spotlight companies have some of the lowest viewership with the lowest engagement, which means the amount that's watched based on their length is the lowest percentage. And they take me 30, 40 hours to do. So that's why I've sort of suspended that, because you look at the market, you look at your analytics, and you say, look, clearly the demand isn't there for that. The desire isn't there for that, so why should I keep supplying it? But when I do these shorter segments, on a particular topic that are maybe 8 to 10 minutes long, they tend to have the highest viewership and the highest engagement. So I think you get more value out of those. So I'm gonna keep doing some of those. Let's get on to S&P right now. Forward 4-quarter operating earnings 374 based on closing SPX. We are peaking, not the old name for China, but peaking as in seeing a little over 20 times. Forward multiple 20.02 versus 19.87. 304 companies have reported so far. 7%. The earnings surprise 7% higher on earnings than was expected. This is the forward expectation. Quarters coming in 7% above that, with revenue coming in 3.3% below that. S&P sitting 1.66% below all-time highs. I anticipate we're going to take those out because this is not over. I would seem to think we could, if the news out of Iran, which I have so little faith in, it's on, off, on, off, on, off. You don't like the state of the war, give it 10 minutes. But if we could get some kind of removal of that problem, I would seem to think that by the end of the week, we could be taking out the all-time highs. IWM only 3% below all-time highs. That was set June 30th. And we got a long way to go on Triple Q, down 7.8%. I think a lot of that was the delevering, both in South Korea, the crackdown on all those levered ETFs in South Korea, and of course the event with the hedge fund that had to unwind, which then caused a whole bunch of weak hands to have to unwind as well. And now that selling pressure is over, I think we are set to recover a significant amount of that. I don't know about new highs by the end of the week because we are quite a bit of ways away. To have an 8% rally in 1 week on an index, I'm not there. However, on a valuation basis, it's not bad. Forward PE multiple of 21.34, just slightly more than S&P 500. Very low volatility, 12.25. You can see it in the percentile, 13-week percentile, 2. Second percentile, down from the 60th. The 26-week, 1%. Nothing to see here, no volatility. Let's have a look at the companies that are reporting this week. They are numerous. Okay, let's have a look at our earnings. This is the S&P 500 only, as it's written on the screen. I didn't fact check any of these to see if in fact this was going to happen. Let's have a look at what we have on Monday. We have some pretty big ones. Diamondback Energy, ticker FANG. I love that ticker. Diamondback Energy expected 125% increase. Why not, right? Palantir expected 117% increase. 35 cents a share is the estimate. Year ago, 16 cents. Let's go into Tuesday. Caterpillar, they've had a bit of a drawdown here. Expected 31% growth in EPS to $6.20. Duke Energy, half of Florida right there, up 4.4. NextEra wasn't too bad. So Duke is the other half of the state. Aptiv, we have Apollo up 13. Aptiv is being beaten up badly. Expected to be down 32.5 on the earnings, 143 versus 212. I would say a lot of that is in the price. Archer Daniels Midland up 54%. Oof. Cummins, big engines, up 12.5%. Who else do we have in here? Kimberly-Clark, Kimco. We're starting to get into the REITs. Marathon Petroleum, they should be doing well. Look at that, 246%. McDonald's up 4.1%, squeaking it out, $3.32 a share. Merck, Pfizer. What else have we got in here? Anything interesting? AMD up 236%, expected to report $1.61. Arista Networks, that's pretty tame, 21% on Arista. Bookings up 10%. Devon Energy, they'd be up to 65%. Who else have we got here? Gilead Sciences, Mosaic, fertilizer, down 80%. Skydance, Paramount Skydance down 67%. Close your eyes, kids, on Wednesday night. It's going to be ugly. Going into Thursday, CVS, Eli Lilly, Global Payments, Iron Mountain, another REIT. Kraft Heinz, how they expected to do, down 23%. The GLP wipeout continues. Phillips 66, how they going to do? Up 212. Uber, I have 5,000 shares of Uber. My average price now, because I keep selling calls, my average price is priced $73, $74, or sub $70 right now, so I'm underwater on this. So come on, Uber. Expected increase 29.3, 81 cents. Let's bring in 92. Come on, let's really crush it. Walt Disney up 15.6%. You know, I subscribed to Disney Plus last week. I paid it. I said, okay, let's watch it. I want to see The Mandalorian because I thought it was a really cool premise, right? And leave it to Disney to ruin the whole thing. I mean, you could really explore the darkness in all of this. Like, I mean, it's after the fall of the blow up of the second Death Star. There's some real stuff that you can explore in this, right? But nope, it's all sunshine and rainbows as far as the eye can see. Everybody likes everybody except the bad guys, and even the bad guys are not really bad guys. Some of the worst fighters in the world are the stormtroopers. The rate at which they get killed, and they can't hit the broadside of a barn. No one gets shot on the good guys, and these guys just boom, 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 they die. Let's go, guys. You hear them bang, 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 20 of them dead. Run away, run away. It's the worst. It's the worst. They could have explored, like, the Dark Troopers. Those were really cool. I really would have liked to have seen that gone somewhere. That would have been a great storyline. Like Star Trek really found its stride with the Borg, right? They should have just done something more with that, create that enemy, but no. It was over right away. They had a Luke Skywalker guy come back, and anybody else just disappointed with the direction they took on this? Let's keep going here. AppPL, there we are, expecting 55%, 3.72. When it broke 400, I saw the 380. I sold 320 puts. You were still getting $10 for the 320s for August. So I sold some puts on AppPL. I think I might want to sell more after seeing Meta's increasing their square. More quantity, more price. That's not just one company. I think that is a demand for advertising that should do well. Axon Enterprises, tasers, anyone? Block, CF Industries, DoorDash, yeah, down 30%. I don't blame that. Expedia, up 21%. Honeywell Aerospace, Motorola, 7.9. News Corp, Occidental, look at that, up 375. Expected $1.85 on Oxy. Another REIT here, Realty Income. Who else do we have down here? Western Digital, up 98%. Seagate was well rewarded, $3.30. Let's see if they get it. We have eBay and SanDisk. Oh, look at this. At some point, it gets ridiculous, right? 11,800% increase. Expecting $34 a share, up from 29 cents a share a year ago. SanDisk. Oof. Going into Thursday. Who do we have here that's interesting? ConocoPhillips, 103%. Constellation Energy, 26%. Fiserv, poor Fiserv. Oh, look at this, down 22%. Expectation down to $1.91. Fox, Keurig Dr. Pepper, 9.6. Beer's just been having a tough time, haven't they? Everywhere. Molson Coors down 26%. Ralph Lauren expected to be up. Who else do we have in here? Warner Brothers, down 120. Poor guys. Datadog, they have been on a tear, up 28%. 59 cents. I feel that's in the price. They've got to come out with much more than that because their price has really responded well. They were a spotlight company. Airbnb up 22%. I have no Airbnb exposure now. Akamai. Gen Digital, that was a spotlight company, expected to be up 7.7%. Monster Beverage, where are we? 14. Trade Desk was a spotlight company. They have just gone straight down, expected to continue their shrinkage. EPS of 40, down from 41. And who else do we have? Vistra is in here as well, up 150%. Woo. And that's it. What was that? That was Friday. This was Thursday, Friday. Really? Only 3 in the morning? Ah, nice and short. It's also Jobs Day in the U.S. We get some labor numbers as well. So if the evil men that determine the state of wars can just shut the fuck up this week, we might have a really good week. Let's just, I'm going to drag Hyperliquid onto the screen as we end here. Here is WTI. We're sitting down around 81.70. There's that big drop on, we're not going to fire anything. We're going to see if we can get a quick deal. We're sitting at 81.70. This is sort of what I watch on the weekends. S&P expected to be up 38 points. on the open. Globex opens at 6. Micron 838. You know, based on what the earnings, what was said on earnings, it is consistent across the board. Memory prices are expected to go up and continue to go up. This should have been nothing but bullish for Micron, and here we are hand wringing at 5 times, a little over 5 times forward earnings. The DRAM ETF is trading at something like 4.4 times forward earnings, right? I think a lot of that was the delevering effect. Now, I don't know that you're going to get that big, huge run up because you're not going to have the leverage there, but I mean, at these prices, that there'd be hand wringing going on. Silver, I think $59, $59.50. You're going to have trouble. 60 is a big, tough point, and that's going to be the case for as long as real yields are elevated. Gold up 15, 4,100 is its tough point. Triple Q expected to open up 0.66%. You can't see the other decimal place, but it's 0.666%, people. Actually, it's not. Otherwise, it would be 0.67. I like to dream. And copper still continuing on. Anyways, that's it. For those of you for the applied level, we will be doing Globex live 6:15. See you then.